Good morning, everyone, and welcome to this Easy Equities webinar with CoreShares. I'm your host today, Sean Keeling, and today we're joined by Chris Rule, who's the Head of Product and Client Solutions at CoreShares. Today, Chris will be chatting to us about what is an ETF and going back to the beginning, which I think is a really important topic, both for investors that are starting out, as well as older investors that sometimes forget about how valuable having ETFs are in your portfolio is. So thanks so much for joining us today, Chris, and thank you to all of you for taking the time out of your day to join us. Hopefully you gain a lot of insight out of this webinar. I hope you're all keeping safe and enjoying a lot more freedom with the ease of the lockdown regulations, as much as I know I am. Just a reminder before we begin, if you're looking for more information around ETFs, you can see on Chris's page that is showing there, our Easy ETF platform. As you can see, that's easyetfs.co.za. That's where it all is for us, as well as where we're hosting our webinars under the Learn tab there. If you're looking to register for webinars or view the past ones, this one will also be posted on the site later today. And we actually have a series of webinars coming up with CoreShares over the next few months that will be covering a variety of topics. So just make sure to check it out and register for them there. As you can see, Chris is showing you the screen of webinars there. Before I start, I just wanted to check that everyone can hear me. So can you please just raise your digital hand? Thanks a lot, guys. I see a few hands there. And please also ask questions as we go in the question box. Chris will get to them after his presentation. So with enough overdue, over to someone a lot more clever than I am. Over to you, Chris.
Thanks, Sean, and thank you for the introduction. It's really great to be back with the Easy Equities guys, presenting, going back to basics, as Sean said, presenting, what is an ETF and all the benefits and merits of investing in ETFs. So please shout if you're struggling to hear me, or if there are any technical challenges. Sean, will you just interrupt me and tell me if there are any challenges? Also, this is all about learning, so please, we've got a brief presentation and then we've got a Q&A session. So spend as much time as you can asking questions, and if you've got anything, whether it's ETF related or Easy Equities related, investing related, don't hesitate to ask. So that's really what this is all about. So once again, thanks so much for joining us. My name is Chris Rule. I looked after our products, so our ETFs and client solutions at CoreShares, and we are an ETF provider on the JSE. I'm sure a lot of you will be familiar with us if you invest in ETFs. But if you're not, we've been an ETF provider for a number of years, and have really enjoyed interacting with the Easy Equities guys. In fact, I was saying to Sean, I did a what is an ETF introduction presentation with the Easy Equities platform all the way back in 2015. So we've walked a long journey, but it's really great to get back to basics. We are passionate about exchange traded funds at CoreShares. And really this is a nice overview and introduction of what is an ETF and what are the benefits. So as I said, we'll probably keep the questions for the end. Sean will fire away and ask me questions as well, and let's keep this interactive. So let's go right back to the basics. What is an ETF? So ETF is this funny acronym. Often people talk about EFTs. We're more familiar with transferring money than investing. Most of us, we do that. So we often hear about EFTs, but an ETF is an exchange traded fund. We can break the acronym down into its various components to actually get a really good understanding of what an ETF is. So an exchange is something or a place where shares are bought and sold. So ETFs trade on an exchange like the JSE, the Johannesburg Stock Exchange, like an ordinary share. So the exchange part obviously relates to how they are transacted, how you can buy them, how you invest in an ETF is through an exchange. They trade it, so they trade throughout the day, like a stock, from market open until market close, and we're going to get into some of the details around how they are traded and how you can trade them. But then probably most importantly, it's a fund. So unlike a share, this is a fund which gives you exposure to a basket of shares, and we'll go into some more details on that. But let's look at some of the kind of legalese behind it. It's a collective investment scheme. A collective investment scheme is effectively what most people talk about as a unit trust, and we're all familiar with unit trusts. and it's regulated by the FSCA, so the Financial Services Conduct Authority, which used to be the FSB. Most people know about the FSB, and the JSE. So they are very highly regulated investment vehicles, and what that means is that it's ring fenced, and you are protected as an investor by a number of different protection mechanisms. So it's a safe investment in terms of being highly regulated by various regulators. So what is an ETF? At the core of it, yes, we know it trades on an exchange now. Yes, we know the exchange in question is the JSE. It means that as an investor, you can go onto your EasyEquities account and buy a Sasol share alongside your CoreShares Top 50 ETF, and they sit in the same ecosystem, in the same portfolio. But as an investor, what you're buying when you're buying an ETF, which is very different to buying individual shares, is you're buying a basket of shares. So this is just a very simple example of what an ETF is. And we've used this little kind of funnel thing to show you that by buying one share, you can actually get access to a whole basket of shares. So in our top 50 ETF, and I'm just using this as a high-level example, top 40 is going to look pretty similar with a few exceptions. You're getting exposure to 50 underlying shares, which is amazing. You go and buy one share, and immediately you get exposure to the 50 largest shares in our market. So Naspers, Shoprite, Standard Bank, Sasol, Sanlam, these are just a few of the names that would form a part of your investment. So why does this make sense for investors? Well, first of all, for an investor, you're getting a well-diversified basket of shares. So to match this in your EasyEquities account, you would have to go and buy 50 different shares in your portfolio. So EasyEquities has no minimums, but you would still need a reasonable sum of money to go and buy 50 shares. With the CoreShares Top 50, it trades at about 20 Rand a share. You can go and own one share for 20 Rand, and you get the effect of diversification across all 50 shares, which is really, really important. Now, CoreShares itself comes out of a name called Core Satellite, and we're going to talk about that a bit later in our webinar series with EasyEquities, but it shows how you can combine ETFs with underlying shares. So why do people like these ETFs? Okay, yes, you get a diversified basket. You go and buy one share, and you get this diversified basket. But there are a number of different cases. They're transparent. So if you go onto our website, you will see all the holdings in the ETF. So this kind of this basket over here, you get full access to as an investor to see all of the underlying holdings. So you understand exactly what the ETF is made up of at any point in time. They're liquid, so they trade in the market. It's regulated that there must be a market maker, which means there's always a buyer and a seller of these ETF securities. Unlike some very small shares where there may not be buyers and sellers, or the spreads, what's known as the spreads, and we'll talk about it, is very wide. So it's liquid. I mentioned diversification. Buying one share gives you exposure to 50. I mean, that's an easy example. If you look at a different example like our S&P 500, you buy one share and you get exposure to 500 US listed shares. So that's just quite amazing. At a low cost that you can get exposure to all these shares. And ETFs have been called the democratization of asset management, and I'll touch on that a bit. And it talks about the cost effectiveness. But essentially, as an individual investing with 1,000 Rand or 500 Rand, you're getting a TER, what's known as a TER, or a cost of that investment that is equivalent to a very large investment from a pension fund, let's say of 1 billion Rand and so forth. So it's making investments accessible to all investors, from very small to large. And that's kind of why you've seen such a huge boom in ETFs worldwide. So there's all these good, let's call them governance things, where it's transparent, it's flexible, it's well governed, it's regulated. But the reality is that this big move to ETFs has been driven by the stellar returns that most ETFs have performed. So how do we measure this? How do we measure this return? And it is pretty difficult to try and use a case study like this across all investors. But essentially, the way that we look at this return is through a measure called SPiva. SPiva is run by S&P Dow Jones, who's a big index provider. And SPiva stands for S&P versus active, S&P indices versus active. So in South Africa, they actually do a SPiva scorecard on all the active managers. So I'm not talking about people who have share trading portfolios, but the unit trust active managers. So the big names that we're all familiar with, who go and stock pick and try and outperform the market. We all know them: Alan Gray, Coronation, 91, who was Investec, Prudential, all these big brands that we see in the market. And it actually looks at how these managers have performed, and there's some 230 odd of them, professional investors, relative to just buying a simple index like the top 50. And what you find is that through time, it's very difficult to outperform the index. So stock picking is an extremely challenging game. In fact, very famous investors like Warren Buffett and so forth have started actively promoting that investors look at options like, he's a US investor, so the S&P 500. At his annual Berkshire Hathaway meeting, he made a recommendation that investors should be looking at low-cost strategies like S&P 500, for example. And our market equivalent would be like a top 50. So this is unbelievable. The active managers who are professionals, who are actuaries, who are CFAs and CAs and engineers and all these really smart people, they really struggle to outperform this. And that's really what's driven the flows and people to start investing more and more in ETFs. More and more, they're realizing that in order to get the most returns for themselves, investing in ETFs is the way forward. So this just shows 93% of those professional investors underperformed at a snapshot at the end of last year. And this is actually quite consistent through time. So if you look at this is over a 5-year period, by the way. Apologies, I should have explained that better. But to the end of December last year, over 5 years, 93% of professional investors underperformed the index. If you look at this through all different times and different snapshots over 5-year rolling windows, you find that it's extremely difficult to outperform this index. Now, it's worth noting that these are professional investors. So these are, people who are extremely skilled investors who have decades and decades of experience who struggle to outperform this index. So it's fair to say that for novice investors, for people, at-home investors, it's at least equally difficult, if not more difficult. So this is really why we're seeing lots of people investing in ETFs. It's this performance story. It's the ability to retain more returns for yourself and to remove some of the gambling or elements of investing. So what drives this? There are a number of things. Stock selection is extremely difficult. It's very difficult as an investor to know which stock will perform well. But if I go back to the beginning, being diverse, so not having all your eggs in one basket, and being cost effective. So our top 50 ETF, as an example, which invests in the 50 largest funds, has a management fee of 20 basis points, has a TER of 26 basis points. So it's 0.26%, is extremely cheap compared to the cost of holding an active unit trust at an average of 1.5%, so 150 basis points, or even investing in your own portfolio where you need to allocate costs to trading. You may be trading at extremely low costs, for example, as an EasyEquities client, at say 25 basis points. As a big institutional investor that CoreShares is, we're trading at around 5 basis points. So, there's a lot of efficiencies when you're scaling and you're pooling a lot of assets together. And that's the benefit, like the cost benefit that comes through in the performance. So, how we wanted to go on a few of the lingos that you'll hear. So ETF, we now know, exchange traded fund, trades on the exchange. It's a collective investment scheme. It's well regulated. Very difficult to outperform these ETFs. They're well diversified. They're low cost. But what is this NAV? People talk about NAV all the time in the ETF world. And NAV is another acronym. It's also used in the unit trust world, but it stands for net asset value. So how do you know what price your ETF should trade at? It's because it's based on a fair way of valuation, an industry standard of valuation called net asset value. Essentially what it does is it takes that pool of assets and values them based on their market value. So, a multi-choice share, an MTN share, an FNB share, they're trading as we speak, and you're creating a market value for this pool of assets. We then add to that a cash balance. So we may have got dividends from those underlying funds. We'll minus from that any expenses, bank charges, etc. Get to a cash balance, and we get to a net asset value of the total fund. Now, that net asset value is essentially the market value of the shares plus any cash balances in the portfolio. To get to a NAV per share, we then divide it by the number of shares in the portfolio. So it's very easy to know what the NAV of the ETF is throughout the day. So that tradability, that T of the ETF is because there's a well-established NAV, there's a well-established value that this underlying share should trade at. Now, as an investor, you can take comfort that one of the things that happens with an ETF, so that you're buying this share at a fair value at the NAV, because you're entering into the market, is that when you trade on the JSE, there's always a market maker. Now, again, this is where the regulation comes in. And what a market maker does is he sits with as a buyer and a seller of the ETFs. And what he ensures he does, or she does, is that they ensure if this is the NAV in the middle, if our net asset value is 10 Rand a share, that they're buying the share just below the NAV and that they're selling the share just above the NAV. Now, why do they have to do this below and above? Well, first of all, they can't buy and sell at the same value because they're not always trading with themselves. So practically, you need to be outside of the NAV, but it takes into account one or two of the costs. Now, this difference between bid and offer, as EasyEquities clients, you'll know, you put in a price, that's your bid. If you put in a sell order, you're going in and you're making an offer. That difference is what's known as the spread in the ETF world. So in terms of our introduction to ETFs, we wanted to talk about some of the acronyms, NAV, we want to talk about a spread. So that spread is the difference between the bid and the offer, and it sits around the NAV. Now, what's great about ETFs and being well regulated is that there's always a market maker. And the market maker's job is to sit with fair buys and sells in the market. So this is what you would normally see on a stockbroking account. You'd see the bid and the offer and the number of shares offered. And that you can take comfort in when you're buying and selling an ETF, that you're not getting ripped off, essentially, that the ETF is offering fair value on both sides of the fence. So that's how one trades an ETF through the market. Now, as we mentioned, we want to open up for questions. So Sean, I'm going to bring you back in, but really this was meant to be a nice high-level introduction to ETFs. Very simple, but we can jump into as much detail as anyone likes now that we've opened up the floor for questions.
Thanks a lot, Chris. I really enjoyed that. I particularly enjoyed the last two slides and understanding the market maker and the NAV, the costing of the ETF. So thanks for that. I hope everyone else enjoyed that as much as I did. I see there are one or two questions in the question bar. And please, guys, Chris said, just throw your questions at us and we'll answer them the best that we can. Chris, I just have a question for you before I go to the guys. Talking about, we've got 78 ETFs on the JSE. Why are some of them are allowed in TFSA and why are some of them not allowed in our TFSA?
That's a great question, Sean. So earlier on in the beginning of the presentation, here it is, apologies. There's a little line here that says qualify for tax-free savings accounts. So the tax-free savings account qualification criteria is actually because it's both an ETF and a collective investment scheme. So a collective investment scheme, as I mentioned earlier, is what everyone refers to as a unit trust. So the ETFs that qualify for tax-free savings are the ones that are also collective investment schemes. Now, there are some ETFs on our market that are not collective investment scheme portfolios. Those are typically your commodity-based ETFs. Now, the reason why the commodity-based ETFs are not collective investment schemes is because under the regulation of the FSCA and the Collective Investment Schemes, what's known as CISCA Control Act, you can't actually have a portfolio that is invested 100% in a commodity. So very simply, those are funds insofar as when you buy that ETF, it's physically backed by the underlying commodity. So if you buy a gold commodity, for example, ETF, the underlying gold is being stored in a warehouse somewhere for you, but they're not actually collective investment schemes. But those do not qualify for tax-free savings accounts. But the most of ETFs on the JSE are CIS portfolios, collective investment portfolios, so they qualify. And that's the very high-level difference between why some qualify for TFSA and some don't.
Great, thanks a lot, Chris. That makes a lot of sense. And I know a lot of people always ask that question and always wonder why some are available and some aren't. So we've got some questions here, so we'll go through them. And please, guys, again, please just hit us with them as you go. And also, I see some things here. Guys, if you missed the intro, the recording of the webinar will be on our Easy ETF site under the webinar tab, in the recording there. So please you can check it out there, as well as it will get emailed to you. So the first question we have here, Chris, is SPiva is relating to SA Top 50. What about S&P 500 versus local active managers?
So yeah, sure. SPiva relates to Top 50. SPiva is a report that's run worldwide by S&P. So they do one with S&P 500, but they do that relative to the US active managers. So if you go to, if you literally Google SPiva, you'll get taken to an S&P website which shares how these different scenarios play out in different markets, in the US and the UK, et cetera, and South Africa obviously being one. So there is actually a report. Interestingly, the reports across the world read fairly consistently. So I would say on average, you probably have about 80% of active managers underperforming the index. And if you look at that across the world, in most markets, that number of 80% of underperformance is fairly consistent. So I don't know the exact number off the top of my head, but it's fair to say that active managers and stock pickers have had an equally difficult time in outperforming their index in the US markets as they have in South Africa. In fact, there was a long time where everyone said, no, passive doesn't work in South Africa because it's easy to outperform the index. I mean, but yes, it does work in the US. So actually what we spend a lot of time doing is trying to show people that no, it actually works in South Africa on an equivalent basis. It's interesting, in South Africa versus the top 50, we've got a cap on our top 50. So we don't, our top 50 ETF, what makes it a bit different to most, say, top 40s is that it has a cap for the largest single stock exposure. So Naspers over here is capped at 10%. It's got the extra 10 shares. So you've got a bit of mid-cap exposure here and a cap. But even with that cap, it still manages to outperform most of the active managers. Now, if you guys listen to active managers, what they've been telling the market for the last 5 or 6 years is that they've underperformed the index because they just simply can't hold so much Naspers. So we spend a lot of time saying, well, that's not true. That can't be the only reason why you're underperforming the index, because our index and our ETF actually caps Naspers at 10%. So we've been underweight Naspers for a long time, and we've kept up, if not, and outperformed most of active.
Okay, thanks, Chris. And that's a great topic to end off there with saying that why you must go for passive management over active management, which is really cool. I have another question here asking, can an ETF hold unlisted shares or investments?
Sean, just let me make sure I understand that. You said, can an ETF hold unlisted shares?
No.
Is that right?
Can it hold unlisted shares? We have a question asking, or does it have to be listed shares?
So I'm interpreting that possibly in 2 different ways. So I'm going to do both, because unless I get clarity, if you get clarity, just let me know. So an ETF, in theory, can hold unlisted shares. In the South African market, or unlisted, let's call them assets. So commodities are not listed, for example. So New Gold invests in gold, which is not a listed asset. It's an asset that trades over the counter in the secondary markets, and there's a fair value on it, but it's not listed. So yes, an ETF in theory can invest in unlisted assets. That's just a simple example. Most ETFs invest in listed assets, so it would be the exception. the other way I interpreted that is, as an investor, can you hold ETFs without them being listed? That would actually be a unit trust. So you can't come to CoreShares and say, I want you to delist these shares, these top 50 shares, and I just want to hold them directly with you. We would then say, rather go and invest in our top 50 unit trust because it's unlisted and it trades on the secondary market. So an unlisted ETF is almost like a unit trust.
Thanks, Chris. I think you hit it on the head there. I don't see anything else around that. The question you're asking if you can shortly go through the levels of risk exposure regarding ETFs, low, intermediate, and high, because it's based on which level of risk should be recommended for a novice investor who's starting off.
Sure. So, I mean, it's quite a loaded question, so I'm going to try and answer it in as many possible ways that I can. So, the first thing is, what is a low, medium, and high risk? And I'm going to go back to this basket picture here to talk about what risk an ETF carries. So essentially, the risk that an individual ETF carries is based on its underlying assets. So, for example, top 50 ETF, holds equities or shares in companies that are listed on the JSE. It holds 50 of them. As I mentioned, it's got a cap of 10%. So, this is how we determine the risk of this ETF is based on a look-through basis of its underlying shares. Now, typically, when we look at risk of investments, we look at a spectrum of cash being the lowest risk through to shares being the highest risk. So based on that, you've got a basket of shares, which is essentially the highest risk investment you can make. What would be low risk would be bonds, and then even lower would be cash. So if you can think of like a continuum, cash being the lowest risk, bonds being somewhere in between, equities and property being right as the riskiest assets. So that's traditionally how we define risk as an investor. And why do we call those assets risky? Because they've got a lot of short-term variability, because share prices move a lot. As an investor, if you invest in a share one day at, let's say, 100 Rand, tomorrow it could be worth 90 Rand. The next day it could be worth 110 Rand. It could drop down to 80 again, and so forth. So as an investor, what you need when you've got a lot of variability in pricing is you need a longer time horizon. So usually what we say is that the longer your time horizon, the riskier your asset mix can be. So the more equities and property you can have less bonds and cash. If you've got a much shorter time horizon, then you want to invest in cash because you want to know with certainty that the money you're putting in, you're going to get out in 2 weeks or 6 months or a year. So you put in 100 Rand into cash, in 6 months, when you pull it out, you're going to get 100 Rand plus your interest. So, you're going to get 103 Rand, for example. And there's a lot of certainty around that outcome. Not the same with equities. Now, it's interesting, at the end of that, you said as a novice investor. So a lot of novice investors, the reason why ETFs are relatively safe investments is because often novice investors open a stockbroking account, and Sean, you can attest to this, I'm sure. And the first thing they do is they go and buy a share that they've maybe seen, in the newspaper, or maybe they shop at Woolworths, so they go and own Woolworths, so they own 1 or 2 or 3 or 4 shares. And that's their portfolio. Now, what that does from a risk perspective is it exposes that investor to one company. In South Africa, we've had our fair share of company mishaps. Steinhoff, Tongaat Hewlett, just off the top of my head in the last literally few years, where there's been massive shareholder distraction and individual investment losses based on individual shares. So, the reason why ETFs are positioned to novice investors is because, let's say you open up an account with EasyEquities, you've got 5,000 Rand, you go and spend 3,000 Rand, you buy the CoreShares Top 50 ETF. The reality is, at any given stage, you won't have more than 300 Rand of that 3,000 Rand exposed to one company. So if that company gets in trouble or has fraud, you're not overexposed. So from a safeness perspective, ETFs are great for novice investors relative to buying individual shares, because you get this benefit of diversification. You get one share that gives you exposure to this whole basket of shares. But as I mentioned, you need to understand what's in your ETF to understand the risk of that ETF. So there's almost a few different angles to look at it. The one is it buying the top 50 relative to cash and bonds risky? Yes. But is buying the top 50 ETF relative to me going and choosing one or two shares risky? No, it's far less risky. But the great thing with an ETF, and this is obviously based on all investing, is that you're not sacrificing returns on the upside. And we can see this through looking at this graphic, where guys who are stock picking are struggling to outperform this underlying index. So it's not a return sacrifice, but you're getting diversification. I guess it's worth noting that, you know, as a novice investor, you need to know what your goals are. You need to understand those goals and how you can invest to achieve those goals. So this webinar is not really designed around that, but rather the understanding of ETFs. But it's a great question, and you know, you should always, before you just invest, understand what you're doing, seek advice, you know, do all those kind of good things. Yeah.
Thanks a lot, Chris. Yeah, I'm sure you're going to touch on it later in the series, but I still think it's awesome to put in all of them talking about risk and the exposure of the ETFs and that. So thank you for touching on all those points. The next one we have is, I know you did touch on TER, but please can you explain EAC and TER, what they mean, and a little bit more about them?
So there's all these acronyms. I will touch on all of them in the later webinars, but I'll give you guys a quick overview. TER stands for total expense ratio. Total expense ratio is made up of a few components, but the main thing it's made up of the management fees, is what, for example, CoreShares would earn for managing the top 50 ETF. So it is it's the compensation CoreShares in this example would earn, and they earn it for rebalancing the portfolio index, you know, ensuring the caps are in place if there's a 10% cap, and so forth. So that makes up most of the TER. There are a whole lot of other costs that come into the TER. For example, the ETF is audited on an annual basis. That cost comes into the TER. The bank fees, because obviously the ETF has its own bank account. The custody fees, because all of these shares are held in safe custody with a third party. So even though you're investing in a CoreShares ETF, in our example, ABSA actually holds these shares in custody so that you as an investor, you know that your shares are always held safely, and that Chris or whoever at CoreShares can't steal your money, essentially. So there's the custodian fees, there's a trustee fee. That trustee fee is to make sure that we are investing in line with our mandate, and equally our trustee is ABSA. So there's a whole lot of costs that come into that TER, and they're for the management of the fund, but they're also for the protection of the investor. That's important to note. Now, in the example of the CoreShares Top 50 ETF, to give you a feeling, our management fee is 0.2%, so 20 basis points. Our TER is 0.26%. So that extra from going from 0.2 to 0.26 is made up of all those costs plus VAT. So the VAT on its own takes us from 0.2 to 0.23. So you're paying 3 basis points for custody, for banks charges and bank fees, for safekeeping, for trustee audits, etc. As an investor, you can request the financial statements of the fund, for example, on an annual basis. So that's what makes up the TER. You then get to another cost calculation known as the TIC. The TIC is the total investment charge. So on top of that, we pay for brokerage, we pay to trade the underlying shares, and essentially the TIC takes into component that trading cost component. So the TIC of the CoreShares Top 50 is 0.29%. So management fee 0.2, TER 0.26, and then the TIC, including trading, is 0.29. So you can see on an annual basis, you're only paying about 3 basis points or 0.03% for the trading on this portfolio. I mentioned how cheap the brokerage rate we get as a big institutional investor are. So that takes you to TIC. Then as an investor, you may have a platform like EasyEquities. That inclusion of that platform cost takes you closer to your EAC, so your effective annual cost. That takes into account the management fee of the portfolio, all of those other fees I talked about, the transaction costs, and then how much it costs for you to actually hold this ETF on the EasyEquities platform. So that's where you get to EAC. There is another component of EAC that may come in, and that's if you've got advice. So let's say if an advisor charges you 0.5%, that would also be included in the EAC. So most investors on EasyEquities don't have an advice component. You can essentially say TIC, ER, TIC, EAC, and then you get your total cost picture as an investor. Now, it's extremely important as an investor that, for example, you keep your EAC low, because it's no good going and buying CoreShares Top 50 ETF at 0.29% if you then run off to a stockbroker who's charging you, 1% or 1.5% to trade, and it's extremely expensive. So that's why, investing with a low-cost platform alongside a low-cost ETFs is a great combination, because you keep your total costs low, and that's obviously really important.
Great, thanks a lot, Chris. I think that touched on quite a few things, and even touched on some of the later questions that were coming around here later on, saying that one of them was, does an ETF sit within a Manco similar to a unit trust? If not, what vehicle is generally used to ring fence the ETF? I think you touched on that a little bit when you were explaining the TER there also.
Yeah, I can.
Go ahead.
Sorry, there seems to be a terrible echo suddenly there. Oh, it's gone. Great. So the question was, does an ETF sit in a Manco like a unit trust? So how the regulations work, I wish I had a little scheme here to explain it, but essentially how unit trusts work and ETFs work exactly the same is you've got what's known as a collective investment scheme. So a scheme of portfolios. Those portfolios are ring fenced. That scheme, that collective investment scheme, is managed by what's known as a Manco or a management company. And in the same way, you have an ETF scheme with ring-fenced underlying portfolios, which is managed by a management company. So in the example of CoreShares Index Tracker Managers is our Manco, and we've got a separate scheme which is managed by the Manco. So yes, the structure is identical to a unit trust. All the protections that you get out of a unit trust, you get out of an ETF.
Thanks, Chris. And also thanks for going forward to the question before. Thanks so much for going into the costing of the instruments around the ETFs. I think that's really important when you're looking at the ETF to buy and which one is going to be good for you. And it's actually one of the features we also built into our Easy ETF site, so that you can compare the different ETFs. As you guys know, there's a lot of ETFs that track the same index, and using our portal, you can actually compare which one has the lower cost, and therefore maybe is the one that you should pick. Chris, we have a question here saying that they see that you can, so for instance, they use Satrix as an example. You can buy an ETF or unit trust that tracks exactly the same index. Why is one then more expensive than the other? Is the one better than the other? Does this include the price aspect also?
So I can't speak on behalf of Satrix, but at CoreShares we do have the same thing. We've got ETFs that track one index and unit trusts that track another index or the same index. So top 50, let's stick with this example. We've got a top 50 ETF, we've got a top 50 unit trust. We actually charge the identical management fee for the two portfolios. So we don't charge different management fees for the underlying portfolios. But what can be different from ETF to unit trust is some of the efficiencies that ETFs get around trading. ETFs tend to have lower transaction costs because they trade in bulk, they trade in wholesale, whereas unit trusts trade every day because they get flows in and out of the fund every day. So their TC. Yeah, so different sizes of funds will have different TERs, and because a lot of the costs are fixed, so audit fees, etc., are fixed, bank charges, custody fees can be fixed. So a larger fund will often have a lower TER. I can give you an example. Our top 50 ETF, which has got about 1.5 billion rand in it, TER of 0.26, and our unit trust, which has got about 1 billion rand in it, has a slightly higher TER of 0.28. So those audit fees, those bank charges make up a bigger component because the fund is small, slightly smaller, say $1 billion and $1.5 billion. As if those funds were the identical size, they would most likely be the same cost. There are additional costs in running a unit trust relative to an ETF, but it does get quite technical. So I think, broad strokes is you should be investing in the vehicle that suits you best, and that's why we have a management fee that is the same on our top 50, let's say, ETF and unit trust. But they absolutely can be quite different. So it's a good observation.
Thanks, Chris, and thanks for. And I don't know if maybe lost you there. So why would you invest in an ETF versus investing in a unit trust? And maybe just to clarify that whole thing there.
Sean, it comes down to preference, to be honest. That's why I was saying, investing in let's say our top 50 ETF versus our top 50 unit trust would come down to your investor preference. Now, that might be just very simply because all your investments are on your EasyEquities platform. So for you, it's easier just to buy an ETF and will sit alongside your holdings in Sasol and maybe your holding in Signia World, or that might be your preference. A lot of advisors, so financial advisors, tend to use unit trusts because that sits comfortably in their operating environment. So it really comes down to preference. What we found is that a lot of the people who preferred stockbroking accounts and so forth buy ETFs, and then you get a lot of people who just want a monthly debit order of say 500 Rand, and they may prefer, and they don't want to keep their eye on it, they may prefer unit trust. So it's really a preference story.
Great, thanks, Chris. I think that ties up well there. We have one or two more questions here, and guys, please just keep them rolling in. Asking, is it a good idea to buy low-risk ETFs for emergency fund money?
Yeah, I mean, absolutely. Emergency fund money, in theory, means you need it potentially immediately because it's an emergency. So, I mean, I can only think of one very low-risk ETF on the exchange that would probably be appropriate, and that would be an ETF. I think it's the Absa Tracy ETF. It's a cash-based ETF. So yeah, close to cash-based ETFs would be the most appropriate for an emergency fund. Most ETFs tend to be in risky assets, so equities, property. There are a number of bond ETFs which are lower risk, but there still is pricing variability in bond ETFs. So just bear in mind that bonds are not risk-free. They do have capital pricing risk, whereas cash, your capital is guaranteed. So in the short term. So yeah.
Thanks, Chris. Our next one is asking with relation to the pricing of the ETFs. Do cheaper ETFs perform as well as the more expensive ones?
So in theory, Sean, if you've got two ETFs tracking the exact same index, so let's take the top 40 index because that's tracked by quite a few. We don't have an ETF that tracks it, but it's tracked by quite a few investment managers. In theory, the lower the cost, the better it is for the client, all else equal. Now, that's quite important that I said all else equal because it assumes that the skills of the different asset managers are identical. So in other words, the ability to track the index, trading skill, and so forth is identical. It can get very close to identical. So in theory, if you're looking for a top 40 index or ETF, you should just be buying the lowest cost one. But do have a look at returns because returns tell the ultimate story. Because there are scenarios where you might find an ETF has a slightly lower cost, but actually has a worse off return because the manager is not as good at essentially their job at tracking the index as a manager with a slightly higher cost. And the costs, like on the top 40, are super tight. So the cheapest in the market is 10 basis points, 0.1%. And I don't know, the most expensive is 0.2 or something, just off the top of my head. So you're talking about fractions of percentages. So you really want to look out for tracking, the ability to track the index. Then if you're looking at like a top 40, another option to look at would be our top 50 ETF. I'm just using this because cost does not determine everything. So why would you buy, let's say, the CoreShares ETF over another top 40 ETF if that top 40 ETF was cheaper? Well, you would buy it because the top 50 ETF has a cap of 10%, so you don't have as much single share exposure, which gives you a more diversified portfolio. And you would buy it because it gives you those extra 10 shares, so that extra mid-cap exposure in your portfolio. So it's not as simple as buying the cheapest ETF. You need to also understand what's inside the ETF, what makes that ETF different. But on a like-for-like basis, if they're tracking the same index, cost is a good indicator.
Thanks a lot, Chris. We only have one or two more questions left here. One of them thinking, and I'm just going to try and answer this because to what I think it is. That says, when investing in ETFs, does it mean that the lifetime cap of 500k is taken from there? I think you're referring to a TFSA. With the TFSA, there is a 500 R500,000 cap, and that is taken from the amount you invest into it. Up to 36,000 you can put in for a year. But if that's only in your TFSA account, if you're doing that in an EasyEquities your ZAR account, there's no cap on it from there.
That's correct, Sean. I won't add anything to that.
Thanks, Chris. We don't have any other ones for now, so guys, I'll give you a minute or two. If you want to throw anything else out for us, please let us know. But I think that's been really good, Chris. I think it really just explains the basics of what an ETF is. So thanks so much for you guys for putting that presentation together for us and showing us just the basics of it. Like I said, it's always good to recap on that. And it's interesting, as you say, that 5 years ago you guys did this. There's always more people coming to the market, and it's always just good for a refresher, even for me just listening and watching this thing. That's exactly why I do invest in ETFs and why they're the main focus of my portfolio. I see there's another question that's just come in quickly, and that says, are there any recommendations on creating a portfolio of ETFs?
Yeah, I mean, I can't give a recommendation of exactly, what ETFs and what blend you should do. But, that's a massive trend, is people, creating portfolios of ETFs. And it's a fantastic way of investing because you can get all the diversification, in the world. Quite literally, on the local exchange, you can buy global funds, emerging market funds, bond funds, China funds, global bond funds, property funds. And by combining them and looking at the risk characteristics of the underlying assets within those ETFs, you can create a solution. In fact, one of our webinars coming up, Sean, is talking about this. So I'd encourage you to tune into that, where we're going to talk about how you can combine different ETFs to help achieve your financial goals or your investment goals. But absolutely, that's a mega trend globally, is people putting ETFs together in portfolios to help achieve their goals and outcomes. And you can achieve hugely different risk and return goals by putting ETFs together. If you hold more cash and bonds and a little bit less equity, suddenly you've got the ability to have shorter term money. If you want to include more risky assets for longer term goals, then you can upweight that. And it's really the world is your oyster when you start mixing ETFs.
Thanks, Chris. And that's just another reminder there, guys. If you just check out for the rest of the series, Chris and the CoreShares team will be going into more depth around everything and giving you guys more insight into what's been happening and what there is potentially that you can do around ETFs. We have another question that came in, Chris, while you're answering that, and that's, are institutional investors big buyers of ETFs?
Not at the moment, Sean, not in South Africa. Our ETF business is probably, off the top of my head, 30 to 40% institutional. And when I say institutional, I'm not talking about pension funds in that context, but relative to the Easy Equity crowds, institutional, so insurers, big multi-managers, so it's people who are investing 200-300 million rand in our ETFs, and then a lot of private client stockbrokers and a lot of investors like Easy Equities investors investing, on their own on a DIY basis. So the institutional investor market tends to, doesn't tend to invest in ETFs at the moment. I think it's starting to change. I think we'll see it change over the next 5 to 10 years. But in the offshore market, certainly institutional investors are using ETFs more and more. it's definitely happening.
Oh, so it's almost a precursor for what's going to happen, yeah, hopefully. I think there's one more question here, Chris, and I think we'll do this our last one, and I think if you can build on the last one that you answered there, it's also asking, is the ETF space growing in South Africa?
It is growing, Sean. The total ETF market has probably grown, in the last 5 years, off the top of my head, around 50% in assets. So, that's pretty good, but off a low base. A business like ours, which has ETFs, we've grown at about 50% per year for the last 5 years. So, there's definitely interest in ETFs. And it's growing at a faster rate than the unit trust market, but that's again off a low base. So, there's a lot of interest. There's a lot of money flowing into ETFs. Is it at where we're seeing it globally? No, not even close. We think it's got a long way to go, but the growth is certainly there.
Oh, thanks, Chris. I mean, building on that 50%, I mean, we've seen on EasyEquities now that we have 500,000 clients, we've got more than 50% of assets under management invested in ETFs. So it is there, and I agree with you. It's going to keep on growing in leaps and bounds. But I think we're going to end it there. So thanks so much for joining us today, Chris, and providing that wonderful presentation. And thank you to everyone that joined us today. I hope you found it very insightful and picked Chris's brain properly.
Yeah, thanks, guys, and thank you, Sean, for your time.
Thanks, guys. Make sure to look out for the next ones of the CoreShares series. We'll have a great day.